So, you thought a lot about your business model and your financial modeling. Now we're going to bring it all together in a statement that is called the P and L. That's short for profit and loss. And basically what this statement does, it shows all the money that's coming into your startup, and then you subtract all the cost, so all the money that goes out of your startup. One important thing to remember, a P&L is always done for a period of time. So either 1 week, 1 month, or 1 quarter or 1 year, whatever is easiest for your business model. Once you pick this period, make sure you pick a period in what we call steady state. So don't draw a P&L for the startup phase or for the growth phase. Think about 2 years, 3 years in advance when your startup is in steady state, so you have a steady inflow and outflow of money. How will the P&L look then? The first thing you're going to put in onto your P&L is the money coming in, what we call revenues. Now, in its easiest form, revenues is the number of products you sell times the price that you sell them for. So if you sell 100 widgets for $1,000, your revenue is $100,000. Very important thing to note, revenues is always excluding VAT. That's short for value added tax. So if your prices include VAT, make sure you take the VAT out before you make this calculation. Then, from the revenues, money coming in, we're going to subtract all the cost, all the money going out. The first line is called the so-called COGS, which is short for cost of goods sold. And what that means is it's all the cost that is directly related to your revenues. For example, if you're a sales business and you buy a widget for 60 euros and then you sell it for 100, then those 60 euros that you spend are cost of goods sold. Also, cost of goods sold is everything that's directly related to the revenue. So transportation cost, insurance cost, any other cost that you have that is directly related to the revenue. And once you do that, the result that you get is called the gross margin. Then, in the next step, you're going to take out all the other costs that you have in this period of time that you chose. The indirect cost. And there's another term for it. It's called the SG&A. That's short for selling, general, and administrative. And it's all the cost that is only indirectly related to the revenues. So for example, the rent for your office building, the CEO salary, or any other cost that you have that's not directly related to the revenue. And if you subtract that, the result of that is what we call operating profit. Sometimes you will also find other terms like earnings from operations or EBIT. It's EBIT, short for earnings before interest and tax. That's basically all the same thing. And what this says is, this is the money that you have left over this period that you picked, after you have subtracted all your costs, both direct and indirect, from the revenues. Now the last thing you want to do is you want to divide that number, operating profit or EBIT, by the revenue figure, and you get a percentage. What you want to make sure is that the percentage that you get here is at least 30%. In case you make this calculation and the number here is significantly lower than 30%, go back to your business models, go back to your assumptions, and try to change them in a way so that when you come back, this number is either at or above 30%. Why do we do that? Everything we do here is about the future, so there's always a high degree of uncertainty. High degree of uncertainty means all these numbers in the end will not come out this way. There will be differences. And the 30% is basically a security buffer to make sure even if those numbers all come out negatively, so the revenue is smaller and the cost is bigger than what you anticipated, you still end up with a profitable business.